Well, here's the big macro story of the evening. Foreign direct investments have slowed down to below $10 billion in the second quarter of this financial year. And the current account deficit has also widened only marginally on a sequential basis. Latha is here with her detailed analysis. Latha, let's start with the current account deficit number. Any cause for concern?
Yes, the current account deficit expanded in the July-September quarter, but largely on expected lines. You must remember the current account deficit is trade deficit plus, invisibles, though, like software earnings, which are not coming via trade, not coming in ships, and therefore not being counted in the trade deficit. Now, trade deficit already we knew in the July, August, September period was as high as 37.5 billion compared to 34 billion in the April-June quarter. So we were expecting the current account deficit to be higher. However, the current account deficit actually is less than what people thought because software earnings are slightly higher at 18.2 billion in that July, August, September quarter compared to 17.5 billion. So it's just about 700 million more. Likewise, private transfers, Indians living abroad and sending money is a little higher at 16.2 billion compared to 16.1 billion in the previous quarter, which is why you have a current account deficit that is at 8.2 billion, slightly higher than the 6.2 billion in Q1, largely because of trade deficit. Let's come to capital accounts. In the capital accounts, FDI has done much worse at 7.8 billion compared to 10.2 billion in Q1. If you looked at portfolio flows, there was outflows of 6.5 billion compared to outflows of only 2.3 billion. So overall, the capital inflows were actually at just about 7.2 billion compared to capital inflows of 18 billion in Q1. So if you subtract from the capital flows the current account deficit, then whereas in the first quarter you had inflows of 11.4 billion, in the second quarter the balance of payment is completely balanced. Capital inflows balance the current account deficit, and there is a marginal deficit of 800 million. So really on expected lines, this will not move the rupee or have any market moving consequences.